So now we can turn our attention to the valuation of bonds with embedded options. And I think that it's not too big a leap to say that what this study session has been leading up to is to get to this particular topic. It's, in my opinion, it's the transformative topic between level 1 and level 2 fixed income. Certainly we've done some other things in expansion, and we have some other things that we're going to talk about still. But I think the evaluation of bonds with embedded options is sort of the centerpiece of this fixed income material. So what do we mean by bonds with embedded options? Well, literally, we can think of this as straight bonds that have an option embedded in the cash flow. So you can't separate them. What kind of options are there? Well, there's these simpler options. So that's going to be a European type option or an American type option. European can only be exercised at maturity. American can be exercised anytime up to maturity, of course. It's these European options where I've drawn these little arrows that I think you ought to focus on, because those are the options that our option models deal with, our option valuation models, and also the types of options we're going to be worried about. So they can only be exercised at maturity. American can be exercised anytime up to and including maturity. There's also a Bermudan option, and that's kind of a hybrid of the American and European, and that can be exercised at maturity and at specific points prior to maturity. So there's three different kinds of options out there. Of course, most traded options are American in nature, and in fact, the embedded options in many bonds are American in nature, at least at some point in the life of the bond. They become American, and so we see a lot of that, but we're going to focus on the European type, and there's good reasons to do that, and you discuss it in the valuation material in the derivatives sections. So complex options, there's an estate option. This gives the bondholder, they have a put that's contingent on the death of the investor. So if you buy a bond, interest rates go up, you really want to invest in those new higher return, higher coupon rate bonds. Well, all you have to do is die, and then you can put those bonds back to the company. Seems like a pretty high price to exercise your option, but nonetheless, that is available. A sinking fund, this is where the issuer has some options. They are essentially, a sinking fund is where they're going to set aside funds to retire the bond at maturity, and they have some options in the way that they go about doing that. And those are complex and in fact, would be difficult to value, but the good news there is that it's beyond the scope of the curriculum, so we really don't have to worry about estate puts or sinking fund type option considerations. So let's think about the valuation of embedded options. And if we want to know the value of an embedded call or the value of an embedded put, what you have to realize, and this is called a contingent claims framework or contingent claims valuation framework, what we have is we have a straight bond, and then we have an option that's attached to it. Okay? They're not separable. You can't trade them separately. You can't strip them out or anything like that. So if we want to know something about the value of an embedded call, well, remember the value of a callable bond. Okay? The value of a callable bond is simply the value of a straight bond less the value of the call that we have effectively sold to the issuer. So a callable bond, the issuer has the right to call the bond away, and we're not going to like that, right? So when do issuers call bonds? Well, if you have a 7% coupon, rates fall to 5%. Okay, well now the issuer is going to be incentivized by the marketplace to call your bond, okay, pay you off at par or maybe par plus some very small call premium, and then reissue at the lower coupon rates, just like you would refinance your mortgage when interest rates fall. So so the value of the callable bond is the value of a straight bond minus the value of the embedded call. So if you know if you have a straight bond and you have a callable bond and a corresponding straight bond, the difference between the price of the two bonds has got to be the value of the embedded call. The bondholder is short that call. They've sold that to the issuer. So when you look at the value of a callable bond, it'll be lower than the value of a straight bond, and you're getting a discount. Okay? So straight bond, otherwise identical callable bond, going to get a discount equal to the value of the embedded call. If you want to know the value of an embedded put, well, it's the same scenario. A puttable bond is a straight bond, and it has a put option, but in this case, it's the issuer that owns the option. So when you buy a puttable bond, you're buying a straight bond, plus you're buying a put. Right? So if you want to know the value of an embedded put option, well, you've got to take the value of a puttable bond and subtract off the value of the straight bond. And of course, what we'd like to be able to do in this reading is come up with how we value callable bonds and how we value puttable bonds. And that will allow us then to understand the value of a callable, or excuse me, the value of the embedded call and the value of the embedded put. All right? So volatility and embedded options. There's a really important idea here that you've got to get on top of, and it's really straightforward, but a lot of people skim over this when they are first learning about bonds with embedded options. Okay? First of all, realize that interest rate volatility does not impact the value of a straight bond. Okay, so if you've gone through the derivatives material, you know that volatility is the option's friend. So if you increase volatility, you're going to increase the value of an option, including an option that is embedded in a bond. Okay, but if we're talking about a straight bond, it has no option-like characteristics. So if we have an increase in interest rate volatility, that doesn't impact the value of a straight bond. Now, where people get confused, I think, is they think, well, increase in volatility. Well, it's true that if rates increase, okay, then we have an increase in, or we'll have a change in the value of the bond, right? So if rates increase, the value of the bond is going to fall. But we're not talking about a change in rates. We're talking about a change in the volatility of rates, and you can think of that as, you know, the uncertainty associated with rates. So if we think, you know, if you look back to, you know, I don't know, where was it, 2008, right? And you look at rates. Well, you know, we had some rate volatility prior to 2008, but when we went into the financial crisis, and you kind of mean this out, think of it as a straight line, when we went into the financial crisis, interest rates didn't change immediately, okay, but our uncertainty of interest rates changed a lot, right? So rates, you know, when we were looking into the future, so if this is time zero, well, we didn't know if rates were going to go way up or way down. You know, what's the Federal Reserve going to do? You know, is Western civilization going to end? All that sort of stuff. Well, this is an increase in volatility. So when we look into the future, how uncertain are we? Well, an increase in uncertainty or volatility or perceived volatility of interest rates will impact the value of an option, but not the value of a straight bond. So we're not saying that rates going up or rates going down doesn't impact the value. It's the volatility that we're talking about. So if rate volatility increases, the value of the embedded options is going to increase. So volatility increases both the values of calls and puts. We talked about that in derivatives as well. So what's going to happen here, if you think of the value of a callable bond, remember we said it's going to be equal to the value of a straight bond less the call that we have sold to the issuer. So if we're looking at this equation, we can say, well, we've got the value of the straight bond. So what's going to happen if rate volatility increases? Well, this is not going to change, right? I'm going to put this horizontal arrow saying that rate volatility isn't going to change the value of the straight bond, but it is going to increase the value of the callable bond. Well, the value of the straight bond stays whatever it is, and the value of the callable bond that we're deducting, okay, we're getting a discount associated with that, goes up, then the value of the callable bond has to go down, right? So if there is an increase in the volatility of interest rates, the value of callable bonds will fall. By the same token, if we come down here and look at straight bonds, or excuse me, putable bonds, well, once again, the value of a straight bond is not impacted. The value of the put option is positively impacted by an increase, but now we're adding that, right? We're buying a put option when we buy a bond. So if we have an increase in the perceived volatility, okay, the forecast volatility, implied volatility is the way we calculate it, of interest rates, then that's going to increase the value of a puttable bond, right? And this is a concept that I would make sure I had a handle on. Good, easy to write questions on, and of course, anytime you see something that's easy to write questions on, you want to make sure you pay a little extra attention to that, right? Okay, so the level and the shape of the yield curve. So when we look at what's going on with the change in value of a bond given a change in interest rates. Okay, well, if you think of the price yield function, so we're looking at the price of the bond over here, and we're looking at you know, yields over here. We'll call it yield to maturity. Well, if we have a normal straight bond, this is going to be the coupon rate, and this will be, you know, our par value over here. Well, this is going to be our normal price yield function, right? So it's you know, it is convex with respect to the origin, all that sort of stuff. We've seen this before. So what happens if we see rates change? Well, if rates fall, so if we're going this way, well, as rates fall, then the value of the straight bond is going to increase. If rates increase, then the value of the straight bond is going to fall. We know that already. But what happens or what is different if this bond is callable? Well, if the bond is callable at 101, right, so the par value plus a 1% penalty, then what we're going to see is that this price yield function is going to start to have this backward bending portion to it. So now it's actually, you can see that it's convex. The straight bond has a convex shape with respect to the origin. When you look at this, what do we call that? Right? So what do we call this if it's bending the other way? Well, if you said concavity, then you're wrong. In finance, we don't have concavity. We have convexity and negative convexity. Anyway, so we've got this price yield function that's negatively convex. So if we looked at an equal change in interest rates, if interest rates could jump up here or they could jump down here, okay, by the same amount, well, you're going to see that if interest rates jump up, the fall in price is going to be greater than if interest rates jump up for the callable bond, because we have this price compression, this backward bending price yield function, or this negative convexity. That's going to put a limit on how much the price of the bond can increase, is all we're really saying here, right? So the upside on a callable bond is limited when rates decline because we have this backward bending portion of the price yield function. That is the negative convexity. And the downside on a putable bond when rates increase is going to be the same thing. So if we look at the normal price yield function like this, well, for a putable bond, it's going to come off like this because you can put it to somebody else. So you'll see that the downside of a putable bond is limited when rates increase. So it's just a matter of thinking of the difference between the straight bond and then how's the convexity of the curve going to change if you add either a call option or a put option. Okay, so when the yield curve is upward sloping, the call option is unlikely to be exercised and has low value, while the put option is valuable. Okay, then it talks about what happens if the curve begins to flatten. I think this is something that you want to make a mental note of. There's no calculations here, but I think it's an interesting point, and it ties us back into our term structure theory, so something that I guess you want to pay a bit of attention to. So here's the point. This is what they're saying. So when the yield curve is upward sloping, the call option is unlikely to be exercised and has low value. Now, why is that? Okay, so when we look at the price yield function, we drew it out just a moment ago. We said, all right, let's see, we can think of interest rates fall, interest rates rise, call option gets exercised, it doesn't get exercised. Well, what's going on here? Well, remember back when we talked about our pure expectations theory, we said the shape of the yield curve, so this is time and this is yields, we can interpret the shape of the yield curve as a pointer, right, to the direction of change in interest rates. Well, if the bond is not being called today, and we have an upward sloping yield curve, well, that upward sloping yield curve means that rates are likely to increase in the future. So if rates are going to be increasing in the future, that makes it less likely that we're going to enter a state of the world where it's going to be profitable for the firm to call the bond, right? So, or to exercise the option. So if we have an upward sloping yield curve, interest rates are going to be increasing in the future, well, that reduces the probability that the bond is going to be called. And if the probability of the bond is going to be called, and I'm playing fast and loose with my probability words here, but anyway, if we decrease the probability of call because interest rates are going to increase in the future, then that call option isn't going to be worth much. Right? On the other hand, if you have a putable bond and you've got this upward sloping yield curve and you think all else equal, that's an indication that interest rates are going to increase in the future, okay, well then that put option is going to become more valuable because if interest rates go way up, you're going to want to exercise your put so you can get your money back and invest in those new higher coupon bonds, right? So again, the point here is that you've got to tie this in your mind back to pure expectations theory, the direction of change in interest rates. So if the bond's callable at par, coupon rate's 5%. Today, interest rates are 6%. So they wouldn't call it today, right? Interest rates are 6. They would have to reissue at 6. They can call it if it gets down to 5. But if interest rates are 6 today and the yield curve is upward sloping, well, that's an indication, perhaps, that interest rates are going to be 7 or 8 or 9 in the future, and then they're certainly not going to call the bond. As the yield curve then starts to flatten, well, then the indication that interest rates are going to increase in the future is going to be smaller, right? So we did have a very steeply sloped, positively sloped yield curve. Well, as it starts to flatten, then we're going to start thinking, well, if it gets completely flat, we know expectations are downward sloping from the liquidity preference theory. Well, that says, maybe interest rates are going to fall. Maybe this call option is going to be valuable. Therefore the value of the call option is going to increase and the value of the put option will lose value. So as the curve becomes more steeped, the value of call options goes down. Okay, as it flattens, okay, the value of put options is going to go down. So anyway, I would make a mental note of that, and this is actually a good reading to sort of make flashcards on. So, you know, draw yourself a picture of a yield curve, talk about upside and downside risk for the puttable and callable bonds. Think about the shape of the yield curve and how the value of the embedded call and puts change. Not quantifying anything here, it's just sort of intuition facts, I guess would be a way to think of it. So what about the valuation of bonds with options? And so we've almost done this. So elsewhere, we have gone through and we've used the binomial interest rate model to value a straight bond. And well, now we're going to take one little tweak, and we're going to be able to do that same exact process, and we're going to be able to value a bond that has an embedded option. So this is just going to be the backwards induction process, like we've seen before. We're going to go in and at every node, so remember it's going to have these little boxes with interest rates, right? That's what we're going to see as the binomial model, right? So we're going to come up here and we'll have all this stuff going out however far we need it. Well, at every node, okay, we're going to go in and we're going to calculate the value of the bond just like we did previously. That is, we're going to say, look, we've got a 50% chance of this and a 50% chance of this. We're going to find the expected value and we're going to discount back. But when we are at a point in time where the option can be exercised, we're going to take that value that we calculate and we're going to compare it to the exercise price. Okay? And if the option will not be exercised, then we're just going to use the value we calculated just like we have previously. But if we're in a state of the world where the option would be exercised, then we're going to throw out that number that we calculated and we're going to put in the exercise value or the exercise price into that node and then just keep working backwards. All right? So to summarize, the value at any node is the average present value of the two possible values for the next period, or the call price if we're talking about a callable bond, whichever is lower. Right? So if it's a callable bond, well, if interest rates are high, the values are going to be low. That's not when they're going to call the bond. If interest rates are low, that makes the value of the bond high if it weren't callable. So we're going to look at the price we calculate. We're going to look at the call price. The call price is lower. Well, we're going to use the call price as the value at that node, and just the opposite for the put. All right. So let's have a look at how this works. So this is going back and looking at the exact same interest rate tree that we've used before. So it's a 7% bond, 2 years to maturity, but now it's callable in 1 year at par. So it's callable here at par values. You can call it for 100. Well, remember when we were up here in the upstate at time 1, we said, okay, we got a 50% chance of getting 107. Maturity value plus the $7 coupon. You got a 50% chance of getting 107, so expected value is 107. We discounted that back at 8%. We got something a little less than 100 in this top box up here, right? So that was how we did it when we valued the non-callable bond. Down here, we have the same thing going on. We got a 50% chance of 107, 50% chance of 107. So we define the expected value, which is 107, kind of boring, 1 period before expiration. But we discounted that back at 5%. So remember, the value that we calculated in here was something like 101.90. Okay? And the point being that when we were valuing a straight bond, we just left the 101.90 in. Right? And that's what we should have done, and here's the arithmetic from it. So we found that in the upstate at time 1, the value of the bond was 99.07, okay, which we brought down here. And then we found in the downstate at time 1, the value was 101.90, which we found brought down here. We didn't make the Andy Holmes mistake. Okay? We added in the $7 coupon, and then we took those values and we discounted, found the expected value, discounted it back at 3%, and we found that the value of the bond was 104.35. Well, what we're going to do differently now is we're going to look at this lower node at time 1 and say, if the bond is worth 101.90 and the firm has the right to call it from us at 100, are they going to exercise? Well, let's see. If we're up here and you have the right to buy something for 100 that's worth 99, well, you don't pay $100 for something that's worth 99. If the firm wants to retire the bonds, then they'll just go in the open market and buy them at 99, save a buck, right? Okay, but down here at 101, so they have the option to buy these at 100 when they're really worth 101.90. And in the real world, we'd have to ask about transactions cost and issuance and all that sort of stuff. But we're not going to worry about that in the CFA exams. So it's just the question of is the call in the money? And it is. So we're going to scratch out that 101.90 and scratch it out here and just going to plug in the $100. So what it's going to look like for us is this. So in the upstate at time 1, we're going to calculate the 9907. Is the option going to be exercised there? Well, not if it's a call option, so we're going to leave that alone. Then we're going to come down to the lower node at time 1. We're going to calculate our 10190, just like we did before. But then we have to ask ourselves, since this is the point at which this option is exercisable, will the firm exercise their option? The answer is yes, they will. Okay, so we're going to scratch out that 10190, all that hard work of finding the expected value and discounting it back, just down the drain. And now we're just going to use the call price plus the coupon payment that would come at the end of the period. And that's going to be what we take, and so we're going to come back to time 0. We're going to say, okay, we got a 50% chance of getting 9907 plus 7. And a 50% chance of getting 107. And we're just going to find the expected value, discount back at 3%, and we're going to find that the value of the callable bond is 103.43. Notice that the value is lower than the straight bond, right? Why? Well, that's the value of the embedded call option that we have given to or sold to the issuer of the bond. So the fact that we get $100 in this state of the world rather than 101.90, okay, that's why the value of the bond is lower to us today, because in that state of the world, we're going to have outcomes that won't be as good as if we had had a straight bond. All right? So what about putable bonds? Okay, all interest-sensitive options are going to be valued in the same manner. So all you got to do is that for valuing any type of bond that has an embedded option, whether it's callable or puttable, or if it has option-like characteristics, some sort of capped floater, or whatever it happens to be, all you got to do is look at the node and say, will this calculated price be what's the value of the bond, or will it be something else, right? Will it be something related to the options? So if we change this and say, okay, it's the same 2-year bond, but it's now puttable in 1 year at par, how does that change things? Well, remember, when we come down here, when we get down to the lower node at time 1, we're going to calculate a value of 101.90. Well, now with a put option, you, the bond holder, has the right to put the bond back to the company at 100. If you have something worth 101.90, are you going to exercise your right to put it to the company for 100? Well, no, you're not, right? If you don't want to hold the bond anymore, you'll sell it in the market for 101.90. So in the lower state, in the down state at time 1, the 101.90 is just going to stay where it is. That's the outcome for the puttable bond. But in the up state at time 1, you're going to look at this 9907 and say, well, I have this bond that's worth 99, but I could give it back to the company and I could get $100 for it. So here your put option is in the money, right? So instead of getting something that's worth 99.07, you get something better. You get something that's worth 100 here. So now when we step back to time 0, we're going to have a 50% chance of getting 107 and a 50% chance of getting 108.90 or whatever that is. And we're going to discount it back at 3%, and we find that the value of the puttable bond is higher. Instead of 104.35 or whatever it was we calculated, it's 104.81. So the put option is going to increase the value of the bond relative to a straight bond. The call option decreases the value of the bond relative to the straight bond, just like we have said previously, right? Okay, so easy stuff. It's just a matter of practice. Go through it a couple of times, and at every node where the option is exercisable, just ask yourself, okay, do I use the calculated value or do I use the exercise price out of the embedded option? All right? So in this case, we calculated a value for the straight bond of 104.35. We calculated a value for the callable bond of 103.43. So the value of the embedded call option has to be 92 cents. Right? So that's the only difference between the two bonds. We did the same thing for the puttable bond. 104.81 was the value of the puttable bond. Subtract off the value of the straight bond. So the value of the embedded put option, okay, if you're buying the puttable bond, you're going to pay 46 cents more per $100 of par value. So this is something I would make sure I had a handle on. Because 1, it comes out of the model, and 2, it's a basic relationship, and then we can overlay, volatility, interest rates, and a few other things like that. So it's a fun area to write questions. All right, so what did we come up with for the value of the callable bond? We came up with 103.43, right? Okay, so we calculated a value from our tree. So we took this tree and, we did all the, we started with it and said, all right, we're going to take today's spot rate and we're going to bootstrap out this lower bound and we're going to, calibrate it with this, formula that gives us all the interest rates above it. And, we worked really hard to generate the tree and then calibrate it so that it gave us gave us arbitrage-free, there we go, arbitrage-free values for these on-the-run Treasury securities. Well, when we take this model that we worked so hard to develop and we run our AA bond through it, okay, we're going to say, okay, we're going to go through, we're going to come up with the value of the bond. We'll assume the bond we've been working with was this AA bond, and we calculated a value of 104.35. And then we look at the newspaper, right? And we see that, so this is what comes out of the model, right? And then we look at the market price, right? And we see that it's 102.71, right? Well, why did this give us the wrong value? Okay, well, it gave us the wrong value because the model is based on benchmark securities, which in the example we're doing are Treasury securities. So this is the model price for a AA bond. That means it has lots of credit risk relative to a Treasury. And if we use Treasury rates to value the cash flows from a risky bond, you're going to get a value that's too high. Well, that shouldn't be a surprise to us then that we get 104 something out of the model. The value is 102.71. What are we going to do about it? Well, what we can do is actually come up with a neat way to think about the value of a bond via its benchmark securities. So just like we calculated a Z-spread by taking a fixed increment and adding it to every interest rate on the theoretical spot rate curve for Treasuries, that was our Z-spread measure. We talked about that previously. So now we're going to do the OAS, and the OAS is going to be the constant interest rate spread added to all rates in the binomial tree, so that we force the model price to be equal to the market price. Okay? So let's say that we take those interest rates that we've been using. So it started at 3, went up to 8, and down to 5, and all that type of stuff. So if we take that and we add, well, let's say 50 basis points to it, right? Well, if we add 50 basis points to it, so here's our 8% rate in the upstated time 1. We're adding 50 basis points, okay, 0.005. So we're going to add 50 basis points to the rate in the upstate at time 1. We're going to add 50 basis points to the downstate at time 1. And then we're going to add 50 basis points to the current spot rate, right? So we're adding 50 basis points everywhere. And look what happens. We come up with a value of 102.71. What is that? What does that mean? In this case, it means the OAS for this bond is equal to 50 basis points, right? So what is that? What's the interpretation of that? What it says is, look, if we calculated the Z-spread for this, it would have been something like 75 basis points. Okay? And the Z-spread, if we calculated the Z-spread for this bond, the Z-spread would be the compensation for liquidity differences, okay, between our bond and the benchmark, for credit risk differences between our bond and the benchmark, but also option risk differences. And the trouble with that is some bonds have little option risk and a lot of credit risk, and others have little credit risk and a lot of option risk. So what we want to do is disentangle this credit and option risk. So if you have a bond with an embedded option, you have to use, something that allows for changes in interest rates to impact the cash flows. And in our case, that's going to be one of two things. We'll talk about the other one later. But here, and the main point for the Level 2 curriculum is that you're going to have to use the binomial interest rate model. Okay, so calculating this OAS, what this is going to be, I would call this the option remove spread. So how much am I earning above the benchmark? How much am I earning above Treasuries, okay, after I impound the impact of this call option? So in other words, when I look in the downstate at time 1, I'm not getting 101.90 there, right? I'm only getting 100. So that bad state of the world has already been impounded into the valuation. So what I'm left with, this 50 basis points, is the spread that I'm earning for maybe liquidity differences and then credit differences. And we'd love to be able to take liquidity out too, but we just don't know how to do that. Let's say that we go in and we do some calculations and we get a Z-spread, okay, equal to 75 basis points. Okay, and we have an OAS equal to 50 basis points. Okay. Okay, well, what kind of bond is that? Well, the fact that the Z-spread is higher, okay, means that the existence of the option eroded some of our return. So in this case, the option cost is 25 basis points, and this must be a callable bond. Right? The bond, the fact that they can call the bond away from us gives us some bad states of the world, okay, and that bond must be, it must be a callable bond. There's actually a couple of other things it could be, but not within the curriculum. So if the OAS is less than the Z-spread, it has to be a callable bond. What if I change the example now and I say, okay, what if the Z-spread is 75 basis points and the OAS is 75 basis points as well? Well, if that's the case, well, then we have a straight bond, right? So for straight bonds, you can calculate the OAS via the binomial model, but you don't have to. Okay? It's more work. You could just use the Z-spread because the Z-spread and the OAS are at least theoretically the same for a straight bond. Okay, what if we had a bond where the Z-spread was 75 basis points and the OAS was 85 basis points? What kind of bond is that? Well, then that must be a putable bond, right? Here, we've got the Z-spread is allowing for, credit risk, all that sort of stuff, but it's not picking up the impact of the optionality on the cash flows. So if you embed the optionality in the cash flows, you actually get higher returns, because there's some states of the world where the value of the bond would go way down, but instead you get to put it back to the issuer, right? So this relationship between the Z-spread and the OAS, if you understand what's going on there, understand what we've done here to calculate the OAS, I think you are in good shape for a lot of this stuff, right? Okay, so that's the option-adjusted spread, and here's the arithmetic on it if you want to go back and look at it. It's where we get this 102.71. We're doing exactly the same thing we've done before. A little higher discount rates because we're adding this 50 basis points, but in the end, we're forcing the model price to be equal to the market price. Right? Okay, what about OAS and volatility? So the assumed level of volatility in a binomial interest rate tree affects the value of the underlying option, right? So if you have high volatility, that's going to make the embedded option high. If you have low volatility, then the embedded option is going to have a lower value. And that's just the way it is, right? Volatility is the option's friend. It always makes them worth more, right? So both calls and puts are going to increase if the volatility is assumed to be higher. So if the option price is higher, the value of the callable bond is going to be lower, right? So if you think, well, all right, I'm going to take the value of this, I'm not going to write it out, but if you take the value of a straight bond and you subtract off the value of the call option to get the value of the callable bond, well, then if we say, all right, if I can make the option worth more, an increase in volatility, that's going to drive down the price of a callable bond, what investors are willing to pay for the callable bond. So what's the point here? The point is that we're thinking about these metrics, and we have to, and volatility is an input to the model. So if you want to keep the market price constant, right? So if the market price is going to be constant, which, we're assuming here the market knows everything. It knows what the right value of the bond is. Okay, then a higher volatility assumption results in a lower computed OAS for callable bonds and a higher computed OAS for puttable bonds. So if you have a higher volatility assumption, okay, it may make a risky callable bond less attractive, okay, and make a risky puttable bond more attractive. And to make sure we're all on the same page here, remember let's just create an example, and we have a market price for a bond that's equal to $934, okay, for whatever reason, right? Well, if we have two different analysts, both of them are going to go in and do a calculation of the OAS. We have one analyst that is going to go in and is going to use a volatility assumption equal to 0.3, and another one that's going to use a volatility assumption equal to 0.4, right? So just having one higher than the other. So I'm not going to plug any numbers into this. I just wanted to make a point. So if we go in and we remember that the value of the callable bond, I'm going to put CB, is equal to the value of a straight bond, V sub S, minus the value of the call, right? Well, so we'll do this on both sides. So the value of the callable bond here is going to be equal to the value of the straight bond minus the value of the call, right? So then what happens? Well, if you have a low volatility assumption, you get a smaller value for the call, and that gives you a bigger value for the value of the callable bond, at least as a starting point, right? So here we're going to get something like the model price from our first round is going to be equal to, we'll call it 942. And over here, where we have a higher volatility assumption, that's going to mean we have a bigger call value, okay? And that's going to give us a lower value for the callable bond. And we're going to say that the model, this model produces an initial value of 940, right? All right, so remember that when we calculate the OAS, okay, we're bringing the value of the bond down. We're saying how much do we need to add to every interest rate in the interest rate tree to bring the value of the bond down to being equal to its market price. So that's how we calculate the OAS. Okay. So what does that say? Well, if you start here with 940, well, maybe you have to add, we'll say the OAS is equal to, I'm going to call it, 60 basis points, right? And that brings us down to 934. So start with 940, add 60 basis points to all the interest rates in the interest rate tree. That brings us down to 934. But over here, we have a higher starting price. So if we got a higher starting price, we got farther to bring that down. So we're going to get an OAS equal to something like, 70 basis points. Right? Now, did the nature of the bond change? Well, the bond is the bond, right? There's nothing in interest rates or interest rates. It's just the function of our assumptions here that is different. So if you want to go to a client and say, hey, I've got this bond that has huge OAS, okay, well, then instead of using standard deviation or volatility assumptions like 0.3, well, let's just change this to 0.03, right? I mean, that's going to make the OAS look huge. And the point of this is to say, look, we're analysts, we're doing valuation, we have inputs, okay, the inputs are all going to be nested, but if you start with a higher volatility assumption, your computed OAS is going to be lower. If you start with a lower OAS, then your computed, start with a lower volatility assumption, then your computed OAS is going to be higher. And it doesn't, I guess God knows what the OAS is, right? But we don't know that, so it's a question of who has the better understanding of interest rate volatility. Okay? But if you look at two analysts and they're looking at the same bond and you get different option-adjusted spreads, well, the likely culprit behind that difference is the fact that they've made different volatility assumptions. So if we keep the market price constant at 934 or whatever I said, higher volatility is going to result in a lower computed OAS. We don't really know what the OAS is. We're trying to get a measure to understand its value. So, but when we compute the OAS, if we start with a higher volatility assumption, we're going to get a lower OAS. And I think I would make sure and have this on a note card or something, this relationship. So if you increase the volatility, so if you increase standard deviation, okay, then what you're going to get, okay, is a lower OAS. Right? So increase the volatility, higher volatility assumption is going to lead to a lower OAS, and this is going to be for CV bonds, right? So callable bonds. It'd be just the opposite for a putable bond. So, so that's what we have here for OAS and volatility, and it's something I think it's just so easy to write questions on, right? Okay, let's change gears just a little bit and talk about effective duration and convexity. We saw this at level 1. We saw these exact formulas. So nothing here that is going to be new, but you ought to be. I'd throw these formulas on my formula sheet or put an asterisk by them somewhere. So this is the formula for effective duration. So this is effective duration, right? It's not what those ED stands for in all the commercials. So anyway, so effective duration. All we're doing here is we're shocking the value of the bond, right? So we have a value of the bond today. That's BV sub 0. Well, what we did last time at level 1 was we had this yield to maturity thing. We plugged it into our calculator. We plugged in 4 variables, solved for the fifth, all that type of stuff. It was really easy. And then we said, well, what happens if we increase the yield by 50 basis points? Well, that's going to be the BV sub plus, right? So if we shock yields up by 50 basis points, that's going to be when we shock yields up. And then we shock yields down by the same amount. That's going to be BV sub minus. And we plug all this in, and it gives us effective duration. And the effective duration comes out to be 6. Remember, that has a direct interpretation. That is the approximate percentage price change for a 1% change in yields, right? And then we said, well, that's great, except for the price function is curvilinear. Okay, the price yield function is curvilinear. And this, you don't see any higher order terms here, so this is a linear concept. So if you think of this as, well, here's our price yield function. So we're looking at yields over here and prices over here. This is the normal price yield function that we're trying to estimate. But if you look at duration, so we're starting here, well, subject to the tolerances of my artistic ability, which are obviously very limited, then duration is linear. So if you're looking at small changes in interest rates, you're just moving over here, you're fine. But the error gets wider, okay, as you get away from the current yield, right, from whatever the yields currently are. So I should have drawn this with more convexity, so something like that. So you can see that if you're only changing a little bit, well, changing from here to here, your duration estimate does a pretty good job. But if you want to have a big change in interest rates, 50 or 75 basis points, then you're going to see that this convexity issue becomes material. So this is the convexity correction, okay, that we talked about at level 1. Nothing new here. Same data for the formula, all that sort of thing. You ought to be able to use duration. You ought to be able to use convexity in order to come up with the approximate percentage price change for a bond, just like we did at level 1. All right? Now, what we want to add to this is, what about duration and convexity with the binomial model? Instead of using your calculator, plugging in a different yield to shock rates like we did at level 1, well, now we're going to use the binomial model. So here's what we're going to do. We're going to start with the binomial interest rates, and we're going to go in and do all the stuff we just did so we get the OAS. So, you know, when we found the OAS, interest rates were, no, they weren't 5, they were 3, and then we added, you know, 0.5 here, and up in this box they were 8, and we added 0.5, and down here they were 5, and we added 0.5. Right? So that's how we got the price to go from 104.35 down to 102.71. So we're going to do all that. We found the OAS to be 50 basis points. Okay? And then we're going to impose a small parallel shift. So we're going to take this 3.5 and we're going to shock it up 25 basis points. Shock this one up 25, shock this one up 25, do the whole thing again, okay? And get a value if interest rates were to increase by 25 basis points. Then that's going to be our BV sub plus. Okay, and then we're going to go back and say, well, let's start from this again and shock interest rates down. So let's shock interest rates down by 25 basis points. That's going to be our BV sub minus. Okay, and then we can just go back to the last slide, you know, BV sub minus, BV sub plus, plug in, and we can get the effective duration for the callable bond. Now, I don't think there's any way you're going to do this on the exam because it just takes too much time, but you may have to do a final step in it or something like that. So being able to think through, okay, effective duration, I know what that is, I know what it means, I know how to use the binomial interest rate model, I know how to get the OAS. How would I link those two things? Well, it's just a matter of starting at the end point for OAS, shocking interest rates up, getting a value, shocking interest rates down, getting a value, and plugging back into the formula. All right, so there's nothing. I don't think you need to memorize these 6 steps or anything like that. Just understand what we're doing in order to calculate effective duration or effective convexity. Okay, let's talk about durations for just a minute. I think these are some factoids that you're going to want to stay on top of. And remember that duration started what we called Macaulay duration back at level 1, and I don't think we need to worry about that at level 2. But it was the weighted average time to maturity. That's literally the way it was calculated. So we found, you looked at all the cash flows, we found their present value, found what portion of those what portion of each cash flow was the bond's value weighted on that, and then multiplied it by the year it came. Okay, so anyway, we ended up with a weighted average time to maturity. So sometimes you still see numbers like duration is equal to 7 years, right? Because originally it was a time function, right? But it still had the same interpretation, that is, duration 7 years, but that also means that if interest rates increase by 1 percentage point, okay, then the value of the bond is going to fall by 7%. So that was Macaulay duration. But if you think of that as sort of anchoring where we're going, well, what's the duration of a zero coupon bond? Well, if you have a 10-year zero coupon bond, then you know, you have today at 0, you have in the future at time 10. Okay, this is where all the cash flows come at time 10. Well, the weighted average time to maturity is going to be equal to 10. Right? So the duration of a zero coupon bond is, notice the approximately here, but approximately equal to its maturity. Okay? So something to keep in mind. What about the duration of a fixed rate bond? Well, if we have a 10-year fixed rate bond, okay, then we're coming over here to 10. We've got $1,000 here, plus, you know, we'll say it's a 3% coupon, so there's another 30. So you got 1,030 of value coming at time 10, but what at time 9? You got $30 here, and time 8 you got $30, you know, all the way back to time 1 you got $30. So some of the cash flows for this bond come before time 10. So if you have a fixed rate bond, the duration, okay, the weighted average time to maturity is just an intuition lever here, is going to be less than 10. All the cash flows don't come at time 10. Some of them come before. So maybe, you know, this is going to have a duration approximately equal to 10. And this one might have a duration equal to, you know, I don't know, we'll call it 8. So that's certainly not the answer. Okay, but anyway, so the duration is going to be shorter than the maturity. Okay, now, what about the duration of a callable or puttable bond, right? Well, and the point here, all right, so when we talk about the duration of a callable or puttable bond, we're looking at a bond that has, you know, maybe it's got 10 years to maturity, since that's what we've been working with, and it's got these contractual cash flows of 30, you know, each year, so it's going to be 30 at 9, and then it's going to be 1,030 here. So we've got all these cash flows going between time 0 and time 10, and if it were a fixed rate bond, we know the duration would be less than 10. But what if this bond is callable here at time 4? Right? So there'd be a $30 coupon payment there. What if it's callable at time 4? Well, there's some probability that the bond is going to be called at time 4, right? So if you look at the duration of a callable or putable bond, well, we're not asked to quantify this, and quantifying it would require lots of assumptions, and it would be fairly tricky, so that's a good thing not to have to do. But there's some possibility that instead of getting 30 here, you're going to get 1,030. So we're going to move these cash flows from here way up because the bond gets called away from us. Okay, well, then that shortens the duration of the bond. So the duration of a callable or putable bond is going to be less than the duration of a normal fixed rate straight bond because there's some probability of it getting called away from you prior to maturity. All right. One other thing that is helpful at other places in the curriculum, it's not too big a deal here, but that is the duration of a floater. Well, remember, a floater is something where you adjust the coupon rate at every reset period. So if we're looking at a 10-year floater, right? Well, here's 0 and time 1 and time 2, out here to time 9. Well, we issue the bond and we say, okay, what are interest rates today? And we set the coupon rate equal to whatever the market rate is. So the value of the bond is going to be $1,000 on its issuance date. But when we get to time 1, if interest rates have gone up, we're going to increase the coupon rate. If interest rates have gone down, we're going to decrease the coupon rate. So we always have it return to 1,000, to its par value, or 100, whichever kind we're working with, at each reset date. So the duration of the bond acts like it matures at the next reset date. So if you have an annual reset, then the longest the duration could be is 1. Right? So the duration of a floater is equal to the time to the next reset. And again, this comes up at a few places in the curriculum, so you may want to make a mental note of that. All right? So that's effective durations. What about one-sided durations? Lots of different ins and outs here. And again, like I said at the beginning of the reading, there's some meat here, right? Getting on top of the binomial model, being able to throw in a put or a call, so value the bond with embedded options. From that, extract the value of the embedded call, embedded put, calculate the OAS. All that stuff is, that's good stuff, right? I mean, you can build item sets around that. Okay, but there's all these other sort of little intuition points. So we're not asked to quantify them. Well, how much less is the duration for a fixed rate bond than a zero coupon bond? And, we're looked at, volatility assumptions in OAS. Well, we're looking at directional impact, right? So we're not actually quantifying it. And same thing here for one-sided durations. We're not quantifying this, but we do need to understand it and be able to think about its impact, and because it's just really easy to write questions on this. Okay, so what's happening here? So the impact of yield changes on the price of bonds with embedded options is asymmetric, right? So we might want to think in terms of one-sided durations, and that means that we're just looking at the volatility if the interest rates move in one way, all right? So if we have when the underlying option is near the money, all right, so the coupon rate is 5, it's callable at par, and we're somewhere between 4.5 and 5.5, depending on if we're talking about a callable or putable bond. Okay, so we're just out of the money. We're getting near the money. Well, for callable bonds, they're going to have lower one-sided down duration. So when interest rates move down, the duration is going to be small. Why is that? Well, let's think about it. So again, we're looking at our price yield function. And if it's a normal bond, we're going to have this curvilinear relationship that looks like this. Okay, and so if this is going to be par value, so I'll call this 100, and this is going to be our 5% coupon, right? Well, if we're looking, if we're here at 5.25 or something, well, what's going to happen to the value of the bond? Well, remember that this call price effectively becomes a ceiling on the value of the bond. So if I could change colors, it would be a little bit easier here. But remember, as we approach the call, then we're going to get this backward bending function, right? This negative convexity. And again, my artistic abilities are quite limited. I can't even draw good stick figures, is what my kids tell me. Anyway, so what does that mean? Well, if you're looking at the change in the value of the bond, so we're here at, interest rates today are, 5.25%. So that's going to be what gives us BV sub 0. So remember the effective duration formula. Effective duration formula is going to be this BV sub minus less the BV, the bond value if interest rates increase. And then there's going to be some stuff down here, but there's going to be a BV sub 0, today's value, right? Well, if you were to just do a normal duration calculation, you would shock interest rates up, so they go this way, and we'd come down the price yield function. And then you'd shock interest rates down, and we could go up the price yield function. But if we're looking just at changes if interest rates fall, then we can just take this as, as the current value. And I'm not suggesting we're going to actually do this on the exam, but we're not going to worry about what happens if interest rates increase, because we're just looking at down duration. What happens if interest rates go down? Well, now, if the value of the bond at 5.25% is, we're going to call it 99, right? So it's 99. Well, what's going to be the value if interest rates drop to, 4%? Okay, well, the worst that it can get to, or the lowest that it can get to, I guess the highest it can get to, is 100, right? In other words, the price changes, this is almost horizontal, right? So as interest rates go down this way, there's not much of a change in this vertical dimension of price. So when you're looking at a callable bond, because of this negative convexity, if rates fall, okay, so rates are going to fall, then what we're going to see is our one-sided down duration is going to be small because the price is going to be almost the same. There's going to be very little downward move in the value of the price because the option is near the money. All right? And it would be just the opposite for a putable bond. So with a putable bond, we have this price yield function. Again, it's curvilinear, but we would take the bottom out of it this way. So the same thing's going to happen there. So your putable bonds are going to have higher one-sided down duration than upside duration, because if you move up, well, this thing flattens out sooner for the putable bond. All right, so for a callable bond, remember, if we're looking at interest rates moving down, one-sided down duration, okay, then we're going to see that the one-sided down duration is going to be small because of that negative convexity in the price yield function of the callable bond. All right? So once again, I think that these are two factoids that I'd want to employ. Okay, let's think about key rate durations. We talked about that a little bit in other places in the curriculum. But what we're looking at is the impact of a par rate changes, or spot rate changes would be another way to think of it, for just specific maturities, right? So this is what we're trying to do here, is measure the sensitivity to non-parallel shifts, and think of this as a way to capture shaping risk. That is, so if interest rates, we're looking at time against yields here. If interest rates are doing, were here, and they moved up to here, so there was a parallel shift, well, there's no shape change, right? That's an all parallel change. But what if we did it so that after the change, interest rates did this, right? So short-term rates didn't change very much, okay, but the slope of the curve changed. Or what if we did this, so that, the slope and the curvature changed? Okay, well, that's shaping risk, and we want to be able to deal with shaping risk, and key rate duration is the way we're going to do that. And what we're going to do, remember, as we talked about before, is we're going to take some limited number of points in the maturity spectrum of the bond. So it's a 30-year bond. We might have 7 to 13 different places in the maturity spectrum, and we're going to calculate a duration for just seeing that particular spot rate or that par rate change. Right? So how sensitive is the value of the bond to a change just in that one rate? So I think it's easiest to see if you think of it in terms of spot rates. Remember that the way we talked about it yesterday is we looked at time against spot rates, and we said, okay, here's all the spot rates for our bond. Okay, so there's our spot rate curve. Well, what if we just change this one up to here? We shock interest rates up, and we shock interest rates down. So just like we did when we calculated effective duration, but there we shocked all the interest rates up and all the interest rates down. What's the sensitivity of the value of this bond to just a change in this 2-year spot rate? Okay, well, that's going to be weighted by, of course, how much of the cash flows come at this time in the bond's life, and then, what is the impact of the interest rate shift? So how long are we going to be discounting? So all else equal, the farther out we are, the more impact it's going to have, okay, because we're, shocking interest rates, and then those shocked rates are going to apply over more periods. Okay, but the point here that we're trying to make is not necessarily to go back and rehash all the key rate duration stuff, okay, but rather to think about how the different spot rates are going to be impacted by the embedded options in the bond, right? So for an option-free bond, we're going to look at the spot rate that is going to be, or the maturity rate that is going to be most important. Okay, is going to be the maturity matched rate. That's not the right way to say that. So when we're looking at different spots in the maturity spectrum, so if it's a 10-year bond, we might look at 2, 5, 7, and 10. Okay? Well, it's the maturity matched rate that's going to have the most impact. Why? Because most of the cash flows come there. So if you're looking at a 10-year bond and you change the 1-year spot rate a little bit, Well, that's not going to have much of an impact because there's only $30 coming there as opposed to $1,030 at the return of principal in 10 years, right? So if you change that 10-year, that is the maturity matched rate, you're going to find that it's going to have a big impact on the value of the bond. Okay, so it's the rate duration for that maturity matched rate is going to be the highest. Okay, it's going to be the most important. For a callable bond with an option deep out of the money, okay, well, how does this change? Well, if it's deep out of the money, that means you've got a low coupon rate. So market rates are 7, coupon rates are 3. Well, the rates have got to fall 4% before the bond gets into the money, right? So this is going to be a deep out of the money embedded call option. Okay, well, in that case, we look at the highest rate durations are going to correspond to maturity. So if you're way out of the money, the value of the option is going to be low, so the rate durations are going to look like they would for an option-free bond. So you got a 10-year bond, okay, it's a straight bond. What's going to be the most important rate duration? It's going to be the 10-year rate duration. Okay, if you have a callable bond that's deep out of the money, okay, well, that option doesn't look like it's going to be exercised. So again, it's the maturity matched rate duration, the 10-year rate duration, that's going to look the most important. So what happens with a putable bond? Okay, so a putable bond that's deep out of the money. Okay, this is where you have high coupon rates. So you got a 10% coupon, and market rates are currently 4%. Okay, it's also going to have the highest rate duration that corresponds to maturity. So think about that, or we haven't really said anything very important here yet. We've said, look, if you have a straight bond, okay, well, the most important rate duration is going to be maturity match. If you have a callable or putable bond, but those options are way out of the money, then the options aren't very important. They're also going to be maturity matched, right? But what happens as the option moves into the money? Okay, well, as the option moves into the money, if it's a call option, so as interest rates fall, well, the likelihood that that option is going to be exercised increases. Okay, and suddenly, instead, if it's callable at time 3 and then it matures at 10, suddenly the call date rate duration is going to become more important. Right now, we're not trying to quantify that here, and thankfully we don't have to do it. Okay, but as that option moves more and more into the money, okay, we're going to see that the rate duration corresponding to the time to exercise is going to become dominant. Right? So all we're doing here is saying, look, if you have a straight bond or any other bond that has options way out of the money and you want to use key rate duration, well, the maturity, the rate duration for the, that meets or that is the same as the maturity of the bond, the maturity matched rate duration, is going to be really dominant. Okay, but if you have embedded options that are near the money, okay, well then the rate duration that is near the exercise date of the option is going to come to dominate. Right? So key rate duration, so this is not something you have to do. We talked about key rate duration elsewhere, implementing it, those types of things. This is a subtle point that I think is easy to write questions on, so it's something that I'd probably want to know something about. All right? Okay, let's talk about convexity. So effective convexity. So convexity is positive, okay, for straight and putable bonds. That means that when we talk about convexity, again, remember we're looking at yields here, we're looking at price here, and for a straight bond we have this, right? So it's a convex function. And for a putable bond, what would change would be, it would kind of come off here earlier, right? So the value, the downside is going to be limited. So the convexity is going to be positive always for straight bonds and for putable bonds. So the price impact of a rate decrease, okay, is going to be higher than the price impact of a rate increase. And we think about this, duration is your friend, right? So we have yields against prices, so same price yield function. And I've been drawing it like this, right? But what if I changed my mind? So what if I did it like this? So yields against prices. And I did the convexity like that, right? So I made it really convex, right? So they almost at an elbow there. Well, if you talk about if rates are increasing, well, you're not moving much on the price function here, right? So, rates can go from whatever this is to this to this to this, and, you may have very little change in price. But when rates start moving down, well, little changes take us from, here, and you don't have to move very far to get way up to here, right? So if you have a convex function, then what you're going to see is that the price gain from a decrease in yields is going to be greater in absolute value terms than the price loss from an increase in yields, right? So that's convexity. That's what convexity does for us. So if interest rates fall, we get big increases. If interest rates increase, we get smaller decreases is what we're saying here. So that's all this says. So convexity is positive for straight and for putable bonds. So the impact of a price rate decrease, okay, the price impact of a rate decrease is higher, okay, than the price of a rate increase. Why? Just because of the convexity of the function. So the price appreciation of a callable bond is going to be limited due to the presence of the short call. What they're calling price compression here, that's the negative convexity. So we don't keep running up the price yield function. We have that negative convexity. So for callable bonds, they have negative convexity when the call is near the money. So if we see price changes there, well, in the limit, you know, we would get something that looked like, if I can draw it without going to a whiteboard here, y against price. And, you know, if this is our normal price yield function, well, this would be the negatively convex part of the function, right? So when we see here, if we get, you know, price changes, well, as the yields fall, we're not going to get much in the way of price changes, is all this is saying. So we're looking at the impact of rate changes and how convexity impacts the magnitude of those rate changes. And again, this is something that I think you want to think about, and you know, if you take these slides that have these sort of intuition, pricing versus whatever attribute, changes in volatility, convexity, that sort of thing, you could make one flashcard for each of these, and I think you'd be in good shape. All right, finally here, let's talk about convertible bonds. So CV bonds here, convertible bonds. These are bonds with embedded options. Okay? So it's a bond that can be converted into a fixed number of shares of common stock. So that is, you know, the bondholder has a call option on the stock where the exercise price is the bond. So that just says, look, if you have a convertible bond, you can give your bond back to the company in exchange for some predetermined number of shares of stock. Okay, so it's an embedded option, just as certainly as calls and puts are embedded options, but it's different in the sense that it is not interest rate sensitive. What's this option going to be sensitive to? It's going to be sensitive to changes in the value of the stock, not necessarily changes in interest rates. Changes in interest rates will impact the, you know, have some impact on the value of the bond, but it's not going to have an impact on the call option because the call is not going to be dominated by changes in interest rates. It has a secondary effect, but anyway. So so the convertible bond is going to be a type of embedded option, okay, but we don't use the binomial interest rate model to value it. Okay, we'd come closer with the binomial stock option pricing model, but we don't do that in the curriculum. All they really do is give us some terminology here. So if you get the terminology down, you're ready to go. So the conversion ratio, that's just the number of shares that you would get if you turned your bond in. So I'm going to say that's 10. We'll just kind of build a little example as we go through. So the market conversion price, that's the effective price per share when converting. So it's just the market price of the bond divided by the conversion ratio. So I'm going to say that the value of the CV bond is equal to 850. Right? So the market conversion price, I'm going to take 850 and I'm going to divide it by 10. And that's going to say that if I bought the bond and immediately converted, it would be like buying the stock for $85 a share. That's all it is, market conversion price. The conversion value is the market price of the stock after conversion times the conversion ratio. So if we think the stock price is equal to 75, well, then we can take 75 times 10, and that gives us 750, right? So the conversion value of the stock would be 750. So no one's going to pay 850 and convert into stock that's worth 750. We know that. What we're trying to do is get an idea of how expensive that embedded option is, right? So the conversion value is going to be 750. So it's the value of the bond, if it were just stock, is going to be 750. Keep that in mind. And the way I said it, if it were stock, is 750. Okay, the straight value of the bond, okay, this is usually going to be given on the exam, but we know it has to be lower. Let's just say it's 800. So convertible, if you buy a bond that has this option to allow you to convert, you're going to pay more for it because you're getting a call option. So we'll just say that the value of a straight bond is 800. Well, this is one of the main things that I think I would focus on. Okay, the minimum value of the convertible bond. Okay, well, it's going to the minimum value is going to be the greater of one of two things. It's going to be the value of the bond as a bond. So the value of the bond as a bond is 800, okay, or the value of the stock, right? So the greater of the conversion value or the straight value. So it's going to be the minimum that it can be, the minimum that the value of the convertible bond can be is the greater of these two things. So this is going to be the minimum value. Now, what would happen if the stock price ran up from 75 to 90? right? Well, then this would change to 900. Well, is it ever going to be the case that you could buy a bond for 850, turn it into the company, immediately get the stock, and sell the stock and get 900? No, that's the easiest of arbitrages, right? So if the price runs up to $90 a share, then we've got to say, okay, the value of the bond, if it were just a straight bond, it's still 800. Okay, the value of the stock, if you convert it, is 900. So now the greater of these two things is 900. So the minimum value is the greater of the straight value of the bond or the conversion value of the stock. Right? So I would pay attention to make sure I knew what was going on there. Market conversion premium, that's the market conversion price, the market conversion price of the stock. So the market conversion price minus the market price of the stock. So in our case, for our little example, that's going to be 85. That's the market conversion price. Minus the price of the stock is 75 is equal to $10. And so this is the premium that we're paying. So it'd be like having paying $10 extra per share. So the market conversion premium ratio, that's just the premium, $10 divided by the market price of the stock. And then the premium over straight value, that's the market value of the bond. Okay, so we said that's 850 divided by the straight value of the bond is 800 minus 1. So what sort of premium are you paying here? So these are just sort of metrics that you would look at. Like if you're valuing stock, you'd look at dividend yield and price to earnings and all that sort of stuff. It doesn't ever give us an answer. Is this a good buy? It's just different ways to look at how expensive that embedded option is, and then you determine whether or not you think it's a good value. So anyway, so convertible bonds, I would know what's going on here with these little valuation metrics, but I think what would be even more important for us would be to think about this in a contingent claims framework, which means we need to think about, well, okay, we have a straight bond, and then what sort of embedded options do we have, and how is the value of this going to change as whatever other factors change that we've been talking about. So what happens here is the CV bond is going to limit downside risk, right? So if you think of buying the stock, well, you buy it today for 75, it can go to 10, right? So stock has lots of downside risk. So if the stock price is low, okay, the convertible bond is still going to have its value as a bond. So if the stock price is low, the stock price falls, the convertible bond is going to be the better investment. So I had my choice. I could buy a convertible bond. I could buy the stock. After I do that, if the stock price falls, I'm going to be glad I bought the bond. Right? If the stock price increases, then the stock is going to outperform. Right? So you're just getting low bond yields over here, but the stock price starts running up. You're going to wish you had bought the stock. Excuse me. And if the stock price is flat, okay, so stock price stays at 75 all the way, for the next 5 years. Well, then you're going to be glad you bought the bond because you're getting the coupon payments. At least you're getting some return there, right? So, and of course, that assumes that there's no change in interest rates or credit risk and that sort of thing. So the convertible bond, okay, it's going to outperform if the stock price goes south or if the stock price stays flat. If the stock price goes north, then you're going to wish you had the stock rather than the bond, all right? Okay, so let's think about what was important here. The binomial model to value callable, putable bonds, calculating the option value here. I think this is the biggest single thing that you want to get a handle on as you look at this reading. So the option adjusted spread, clearly that's going to be something you want to understand. The volatility and the OAS. So that was thinking about our volatility assumption. How does that change the OAS? Remember, high volatility gives you low OAS. So if you're trying to sell bonds, convince your analyst to use low volatility. That'll make you give you a high calculated OAS. Key rate and one-sided durations. I think there's some good intuition nuggets there. And then a little bit about these CV bonds at the end. In this reading, there's lots of sort of subtle points that make for great questions about intuition and how these things interact. So if you're going to make any flashcards for the exam, this would be a reading that I think would be a good one to do that on, just so you can keep all those little relationships straight. But what you're going to find is that the intuition is very synergetic, yes. So that means that when you learn one of these things, that's going to help you understand the next one, and you know two of them, well, you're going to see that this becomes a fairly robust intellectual environment, and I think you're going to get on top of it and do really well. Good luck.